Welcome to TaxSale Insiders, the latest from TaxSale Resources, bringing you information about tax sales from experts in the industry. TSR has interviewed a variety of industry leaders across the country, including Stephen Morell of Juristine in Louisiana, Maureen Zink of Carlisle Law in Ohio, John Stenko of Stenko McCarthy Law Group in Illinois, and many, many more. The following is just a small snippet of a longer, in-depth interview with one of these leading industry experts. We interviewed Michael Bacalar of Bacalar & Associates based in Coral Springs, Florida. Bacalar & Associates is a real estate-focused law firm, and they know all the ins and outs to the Florida tax sale process. In this clip, Michael shares how mortgage foreclosures are wiped out during the tax deed process in Florida. Good stuff, so stay tuned.
So you did mention something interesting, so I want to ask a little further on that. You said if they are named in the notification, right, that the county does. So if a county misses a mortgage holder on a property and they don't name them, that means that that mortgage wasn't wiped out?
Correct.
Does that happen often?
It happens more often in residential single-family homes than it does for condominiums.
Mm-hmm.
When someone's looking at a title search to prepare a lawsuit, whether it's a foreclosure or a quiet title action, if you do a search back to the date when the property was platted, it could be a long search and someone has to examine it. But somewhere in there, you'll see the recorded declaration of covenants and restrictions for ABC Homeowners Association. Subsequent to that, when the person buys their property, meaning the person who hasn't paid taxes and that property is going to sale, they may get a loan. So you'll see the recorded mortgage on the title search. All the counties use a third party to do a title search report that tells them these are all the encumbrances and all the things that need to be resolved to try to transact the property at a tax deed sale. If the county, for whatever reason, doesn't name all those parties or thinks that one of those parties is dispensable and doesn't need to be named, it turns out they're wrong, then that interest survives. So case in point, we had a property that was in northern Florida. There were two mortgages, both with Wells Fargo. They named Wells Fargo and the servicer for the first mortgage, but not for the home equity line. That was not the second mortgage. It was like a $35,000 second. But that second wasn't named either by the recording of where the public record recording for the book and page and date of that mortgage. And they also had two different addresses. The primary mortgage was serviced by one company and the second was serviced by MERS, and they have different addresses, and that wasn't noticed on the county's lawsuit. So the first got foreclosed out, the second did not. So the investor doing their homework, and this guy was sharp, he said, look, it looks like the county didn't name this other mortgage. Do I have to worry about it? And the answer was yes. That would have added $35,000. They would have taken away $35,000 of his equity. And the reason is because that mortgage is recorded prior in time to his new deed. So yeah.
So he can't, I guess a quiet title in that instance doesn't wipe that out.
No.
So it's not a oops by the county. We'll deal with it in the quiet title. That was a really good catch on that investor's part that they caught that, because they would have inherited that mortgage and there's nothing you can do about it at that point.
Correct.